hear, how are we going to end this year? Are we going to end it strong? Are we going to end it weak? And can we be optimistic for 2025? Go ahead, Lou. Thank you so much again.
Thanks, James. It's such an honor to be here on a Wednesday morning right after the Labor Day. I saw somebody's driving. Appreciate you being focused on the road condition, but also tuning into the presentation today. A little bit about myself and who I am, where I work. I have been with Moody's for 12 years. Oh gosh, it should be longer now, 13 years, still counting. In the commercial real estate world for nearly 2 decades. And I work in the Bay Area and I live on the peninsula. For anybody who's closer to me, say hi. And I know I only have 30 minutes, so without just talking too much about myself, let's dive in, shall we? Okay. Want to see if I'm sharing my screen properly, James. Do you see just one screen?
This is perfect. We can see it now.
Okay, perfect.
Yes.
Okay, I have my title, my job listed on here, and you can find me on LinkedIn. So no further ado. This presentation, I know we only have 30 minutes, will be divided into 3 major components. The first one, I will be walking us through the current economic performance without me introducing. You probably know most of it already. So that'll be short. I will transition into the capital market side of things, primarily focusing on multifamily, industrial, retail. I know we have less focus on office in this group, but for anybody who wants to hear a little bit about office, I plug in some of the data points there. You can read it off the screen or you can connect me afterwards. Lastly, I will spend most of the time, 15, 20 minutes there on the market space market performance. So I know James killed me for that big question. Where are we seeing for the second half of the year in terms of the interest rate? So let's refresh our memory on the dual mandate, right? So we put a very big font on the screen, maximum employment and stable price. The last one, the moderate long-term interest rate, is the neutral rate we are talking here. So that is really in supportive of the two mandates, maximum employment and stable prices. So in terms of the upcoming FOMC meeting in September and all eyes on Friday, so the job market data, where are we? Are we really 100% there? So let's see. I usually deal with multiple different signals, and this is my favorite chart because it does put the unemployment rate and PCE, deflator inflation, which is the Fed preferred measure of inflation, consumer price expenditure. So these 2 measures on the screen. So we have the ebbs and flows, and many of us are familiar with the pandemic shutdown, the American Rescue Plan, and how the inflation and unemployment has been moving along with different economic triggers. So now, if you focus on the tail end of the economic cycle, the bolder blue is inching closer to the inflation target, which is 2%. Although if you remember what was printed on here, there has never been a saying we should go back to that 2 percentage point, but it's just the market consensus. It usually is a neutral rate which support the maximum GDP growth, but also without going into that deflationary spiral. And full employment rate. So usually depending on what time period we are looking, it's safe to say somewhere between 4 to 4.5 percentage point for the unemployment rate is a maximum full employment rate. So we are, from the last July reading, we inched further up to 4.3%. And for anybody who has been helping our clients with their investment strategy, or you have been focusing on the stock market turmoil, just about a month ago, we had that short period of time where the market has been correcting itself, and it's really from that labor market report. So with that being said, we are much more like a soft landing. But that turmoil also speaks for a possibility of a recession, right? So we are getting, I think it's better to show this one, we are getting a lot of mixed signals, especially on the labor market front. So usually every year, BLS is adjusting its benchmark labor force rate, and we re-benchmark against March this year, and we saw, well, the employment actually reduced by 818,000 on the marketplace. And that is a big revision, which inspired a lot of conspiracy theory. Were BLS trying to hide something? Were there anything which they didn't capture? And the reality is, usually we do see a lot of corrections when the market started turning. And compounding that with the most recent uptick on the unemployment rate from 4.1 to 4.3%, Sum's rule has been triggered. So Claudia Sum is a professor, and she has been monitoring every single recession, and she found there is a very strong positive correlation between the unemployment rate changes and the possibility of a recession. So what they state is, if you look at a 3 month moving average, meaning, for example, right now we will be looking at a moving average of May, June, July unemployment rate. And if we take an average of that 3 months, compare that with what has been the lowest point over the past 12 months. If the 3 month moving average is 0.5%, which is 50 basis points above the lowest point over the past 12 months, then we're probably a few months in the recession already. And that has been, well justified over the past recession, which are listed on the screen. The market panicked. And it's very interesting. We are in a very atypical economic cycle right now. So that's why the market, ourselves, investors, market participant has been getting really confused about all these mixed signals. We have been talking about the inverse yield curve, right? The 10-year versus 2-year. And we have been talking about the Sum's rule. And we have been questioning ourselves over and over, are we in a recession? Are we there yet? And look at the reality. We are actually looking at a increase, and it's a significant increase in the labor force participation rate. So the increase of the unemployment rate, instead of causing by a pullback from the labor supply, is actually causing by a opposite force. And it's hard to tell this is an indication of the recession. Okay. $1 million question. Will the Fed cut rate? So on this screen, we listed a couple of key market indicators. Federal fund rates, which is where we are seeing now, settled in the 5.25% to 5.5% range for quite some time, about a year. And then we also compare and contrast with 10-year Treasury and 30-year fixed mortgage, because we do think that has a great implication on the commercial real estate world. So we are looking, apologies. We are looking to start seeing the interest rate cut, very likely to be in September. The big question is, would that be 25 basis point or 50 basis point? We do think it's based on the current Fed FOMC meeting committee and their conservativeness in terms of adjusting the interest rate. We are very much likely to see a 25 basis point. There may or may not be a second interest rate cut towards the end of this year, but the market was waiting for the interest rate clarity, because the transaction, the lending volume, all depends on where we are in terms of the monetary policy. But we are looking at, pulling the federal fund rate, which is the base rate, into the 3 to 4 percentage points in later 25 to early 26. So what that indicates is, very likely every other FOMC meeting in 2025, we might start seeing 25 basis point cuts throughout the year. And depending on how many interest rate cuts we are getting for the next year, there may be lingering cuts into 2026 to eventually pull the base rate back to the 3 percentage point. And contrasting that with 10-year Treasury. So 10-year Treasury seems to be settling very comfortably at around 4%, and that is a neutral rate. For me, it's very easy to remember. So this 4% neutral rate is a combination of 2% and 2%. So the first 2% is the US economy growth potential, that GDP growth rate at 2%. And the other 2% is the unemployment rate, 2%. So usually when the 10-year treasury is benched against a maximum potential of the US economy growth, and also a full employment rate. So that is where we usually deem as the neutral rate for the 10-year treasury. It's already hovering or even falling below that 4 percentage point neutral rate level, meaning all those future rate cut has already been priced in to that 10-year treasury because it does, perceive as a longer term interest rate, which adjusts more mildly than the base rate interest rate. And the 30-year fixed mortgage, I think we have all been seeing the welcome news coming from the 30-year fixed mortgage rate coming down from its peak 7% down to above 6%. So we are continue seeing that settle in, and eventually, if you look at the long-term projection, will be settled around 6 percentage points. So the extremely low interest rate regime is likely already behind us. So we are settling in this longer, higher for longer regime, which will start driving a lot of the lending volume, transaction volume we are going to talk about in the next few slides. So before we move on to the capital market side of things, I do want to just spend a little time on the demand side, right? We talk about the supply, we talk about the volumes, but then on the demand side, I put a couple of indicators we have been tracking: employment, household median income, number of household, and corporate profits, all on the same chart. So except for the corporate profits, which does have a lot of volatilities, much more volatile depending on the economic cycle, depending on the borrowing rate, and depending on a lot of other things related to the corporations. But everything related to the demographics remain positive in the longer run. So that serves the tailwind for the multifamily, retail, industrial. We will talk about it because we had a exceptional years during the pandemic caused by the supply chain side of tailwind. But we are coming to the tail end of that momentum, which may be true across many markets, but really depends on where you are. Some of the markets continue to see that renewed energy on the industrial space. Okay. Capital markets. I think this might be the most telling picture of all. We are counting a couple of indicators to see where we are in terms of the capital market cycle, which includes transaction volume, lending volume, value appreciation or depreciation, and credit quality of all the commercial mortgages. So where we are seeing a lot of the transaction volume slows, lending pullback, value decline, credit worsens, and we have also counted how many quarters of downturn we have seen so far. And what interestingly is we compare and contrast that with great financial crisis, which was probably still, somewhat fresh on many people's mind. So during the GFC period, the value decline, the transaction volume pullback, lending pullback was roughly about 9 quarters. We're 7 quarters in the current cycle. We are getting real close to the end of the current downturn, which is really encouraging. So the following few slides will show some of the promising signs by going through every single indicator. So I'm going to go really, really fast. So this one, we put the repeated sales value index on the screen. Okay, so for anybody who's not driving and who happens to have a ruler next to you, I want you to do this very simple exercise. Just connect the dots, right? So this is before the market started showing extreme volatilities, right? This is where the value sits in 2020, right at the beginning of the pandemic. This is where we are. And the future projection. If you really just connect the dots here, a lot of that atypical, sorry for repeating this word, atypical behavior from the valuation front has been readjusting itself and coming to the normalization. right? That happens to the apartment side of things. It happens to retail. It's just not happening for office for now. We are seeing the current headwind will continue to run for the office sector for longer period of time, because really we are seeing the hybrid working, which has a lot of relevance and implication on the apartment, retail, warehouse anyhow, but that changes is here to stay, right? We are seeing a lot of normalization of that pattern, which has implication on where people decided to live, move, migrate, and where the retail has been most successful, depending on the center of the population. Warehouse has been going through some exceptional growth during the pandemic, and it will continue that upward trajectory on the valuation front. So if you connect the dots, it's probably a ramp up. But otherwise, for some of the sector, we are seeing some of the value correction. You are likely coming down to the normalization in terms of the path. This one shows the trading volume. We started seeing capturing the first positive after this many of declines that we have been seeing since the beginning of 2022, which is really encouraging because a lot of the bottom has really been shaping over the past half of the 2024. And although this positive is very marginal, we are actually comparing that with the 12 of the transaction volume. We are roughly around 9 to 10 percentage point higher than this trough. So I think that's really encouraging. It's non-negligible progress. And we usually say 1 month of data is not a trend, 1 quarter may not be a trend, but now we're continuously seeing this positive development on the transaction volume front. So that is an encouraging sign. We are also started seeing a lot more variety in terms of the big asset, big value asset, medium-sized asset versus smaller size asset. Instead of many quarters in the past, we've seen a lot of idiosyncrasy, which drives the transaction volumes. Annualized return. So this one we borrow from NCREIF. So we are seeing a lot of flat lines over the past year or so. And now 4 out of the 5 property types, which excluding office sector, has now turning positive. So this is the negative leverage we use very often in the industry. A lot of that total return staying in the negative was because of the value depreciation. But now we are seeing the income is stabilizing and some of the value has been started to appreciate. So that really pulled the total return into the positive territory. Interest rate. So we are starting to see some of the interest rate coming down across multiple different commercial sectors, right? So the 10-year Treasury, I know this is a little older data because that captured by the end of June, but since then it has come down back to below 4 percentage points. So we'll likely continue seeing the interest rate coming down, which usually goes with the 10-year Treasury. There has been some property type differentiations there, but the larger trend is heading into the downward trajectory. The cap rate, a lot of the transaction in the multifamily sector hasn't been happening is really because of this extremely tight cap rate premium. And it really doesn't, justify the necessity of transacting unless it's due to idiosyncratic reasons. And also depending on the long-term trajectory of the return coming from the stable income for apartment sector, it's likely not going to hurt apartment sector very much. But by and large, we are seeing a lot of slow movement on the property cap rates across other sectors in the space. Okay. I think I should quickly move on to the space market discussion. I realize I used more time than I wanted. So without
Lou, you have
yes.
the time. You have the time, Lou. So please go because I think this is really good information. So please take the whole time up to 50 minutes to the hour. So please continue.
Okay, that's reassuring. Thanks, James. The LTV and DSCR, the DSCR hasn't budged for much, and much of that reason was because of the interest rate hasn't moved the needle too much. So the income and debt service payment hasn't been changing their relationship to that significant degree to see any diverging trend. But what is interesting, this is on the left-hand side, origination LTV. And by the way, this is the data and analysis based on the CMBS universe. And we started seeing that silently has been taking up over the first half of the year. And the reason was really because of the lenders are putting a more positive attitude towards the future value appreciation. So they are now more comfortable of raising this loan to value ratio a little higher. So we have been in this 55%, right around that borderline for quite some time. So we are now moving back to the normal 60 to 65% LTV. Okay. So lastly, I know this is a very busy table. We often produce this table after at the end of every single quarter, but I wouldn't let you stare at the table looking at the data for too long. I'm pretty sure, James, you have my full permission of sharing the presentation slides afterwards. If you want to keep the data, you are more than welcome to, but I want you to focus on the next slide, because we as a multifamily sector has been going through a very interesting mini cycle, which was featured on the top left corner of the slide. At the beginning of the pandemic, the market has gone through very quick and very sad contraction because of the changes in lifestyle. And then the market has been embracing this rapid recovery, which caused a lot of construction boom that we have been seeing around the country. It really encouraged a lot of the permit issuance, new construction, especially in the Sun Belt region. Okay, that's where people decided this is the place they want to move into, and this is the place they want to comfortably working from home or moving back to live with the family and friends. And after that, when all the trend has been stabilizing, the market has been going through a deceleration because it's really just pushing that rent level to a super high peak, which caused a lot of affordability issue. And also, people have been getting ready. So part of the people were getting ready to work back in the office space, even if that's not 5 days a week, at least 2, 3 days a week. And they really settled in where they wanted to live close to the office, but not necessarily to be in the downtown area. And other people have been taking advantages of some of the pandemic discount. Some people decided to move back to some of the major metros like New York City, Boston, Chicago, maybe not necessarily in the San Francisco Bay Area, but a lot of that trend has been normalizing during this time period. So now we are seeing a lot of stabilization. We have been observing a couple of quarters of either marginally negative rent decline on a year-over-year basis, or slightly positive. But roughly speaking, it's it's the marginal decrease or increase is small enough to cause either a recession or the market decline. It just really we settle in this stabilization. Of course, wait until we see the September data because this is one of the busiest moving months in apartment space. We are started seeing a lot of the shifting from the negative territory to the positive territory across the 270 plus markets we are tracking nationwide, which seems to just suggest a positive trend is forming. But again, wait and see, right? A lot of substitution effect will start to play when the locking effect on the single family housing front is loosening up. On the right-hand side, what I found interesting was to pair the apartment effective revenue growth, which essentially is calculated using effective rent times occupancy rate, because we want to move out all the vacancy out from the calculation of how much revenue we are going to generate from the, the potential income, potential occupancy. And compare and contrast that with the CPI index. And it's very interesting, although we talk about the ebbs and flows of the apartment effective revenue, it continued to beat the CPI index, which is marked in the darker blue in recent years. I think we are still in this very strong demographic, sorry. It's too early in the morning for me. I was not talking about politics, but demographics trend we are in, because the millennials, especially the younger millennials, are continue to be the strongest renter household, or they occupy, I mean, they take a good portion of the renter household we are seeing today. And then the Gen Zers, they are entering the renter market, compounding that with the recent surge in the international immigrants. So all these are the strong tailwind for apartment market. So although we have been seeing some steadiness or even marginally negative growth in recent time, but really on the long run, I still see a very promising future, especially given the housing shortage, which we will talk about briefly at the end of the apartment sector. But what we shouldn't be ignoring is the operating challenges, which you probably heard from your clients near and dear to their heart, to their operations, to their business. So oftentimes we heard people complaining, well, the insurance has been really taking up in the recent years. I mean, one reason is, of course, the surge in the natural disaster because of the climate changes, but really there has been a lot of increase in the replacement cost. So the labor material has all been rising over the past few years, for good or ill, but people have been talking a lot, whether that's 50% increase, double the cost, and so on. But really, when we break down the operating expenses into the typical categories which are shown on the income statement, payrolls and benefit, utilities, repairs and maintenance actually are surpassing the increases in the property insurance. And the reason is a lot of those categories are actually tied down to people. The increase of cost of labor has been playing a very pivotal role in terms of driving some of the components here. So on the left-hand side, the lighter blue is what we have been experiencing between 2010 to 2020, and then you can compare and contrast with what has been going on during the COVID pandemic era. So it's very evident that the COVID surge in the pricing for goods and services has really been causing a lot of operating headache for many of the apartment owners and investors and operators. And adding that to some of the flatline, it's no surprising we have been seeing some of the recent plummet in the multifamily permit issuance. But without talking about the future, let's look at the reality first. Some of the high vacancy metros have been experiencing larger effective revenue decline. So when we plot, so those are the top 81 metros we are tracking. And there is a strong negative correlations between their current vacancy level and their effective revenue growth on a year-over-year basis. So if you don't get to see the chart very clearly, I can just put the numbers in a more narrative way. So the higher the vacancy, which is on the bottom right, the lower the effective revenue growth will be. And the losers in this space, only from the effective revenue growth perspective, are some of the star metros actually. They have been going through a construction boom because of the higher demand, because of the relaxation of the zoning regime, some of the construction code and red tapes. Austin, Minneapolis, Raleigh-Durham, Jacksonville. So all these places have been welcoming a lot of new construction deliveries over the past year or so. And they actually suffered from effective revenue growth front. And the reason was not because they have developed so many apartment units, which nobody wanted. It's really that demand needs time to catch up with the supply. Okay, we are continue seeing a lot of the young professionals moving to Austin, and Minneapolis is a star metro, which attracted a lot of renter attention. If you look at the search, right? So you can actually track people's footprint in terms of where they are searching in the next stop for moving. And Minneapolis has been right on top of that list. Raleigh-Durham Research Triangle, I mean, there has been a lot of young graduates and looking for job, looking for lifestyle. There's no problem there, but there has been a lot of frictions in the market because people need time to move from their old apartment over to the new apartment, and the affordability or the price advantages needs time to attract new tenants. So I'm not worried, but this is just a very negative correlation we are seeing here, which doesn't mean everybody is a loser. So Wichita, Hartford, some of the more affordable places in the space, they are continue seeing strong and positive effective revenue growth because of their lifestyle and affordability and job opportunities, right? So even with slightly higher vacancy compared to others, they continue to see strong revenue growth. And this is also a very interesting divergence between the pandemic darlings taking places in Florida, places in Arizona, Texas, or even Nevada as an example, right? During the pandemic, they are darlings. They attracted a lot of the renter household. They are getting a lot of the in-migration, and now they are seeing the vacancy is taking up with the increase in inventory. But on the contrary, at the bottom, shaded in green on this chart, are the traditionally gateway metros: Chicago, Boston, New York City, San Francisco, San Jose, Los Angeles. So all these expensive markets are actually seeing a positive demographic tailwind, not necessarily positive population growth, taking Los Angeles as a counterexample, but the renter household. It's very interesting. In the following slide, you will see it's not always in that one-on-one relationship with population growth. A lot of that reason is coming from how many people are packed into a single household and how many are single family homeowner and how many are renter household. We are seeing the home ownership has been pulling back at the national level slightly, and also we are getting a lot of immigrants which are helping with the renters market. But by and large, at the expensive metros, with the inventory growth in recent years, we continue to see vacancy decline, which is really positive, which we have been waiting for, that negative correlation across those markets. And we have also been talking for some time the trading up phenomena, because together with the inventory growth, we are seeing some of the Class A rent has been softening, although the more affordable Class B, C has been stabilizing, right? Which really just closing up that gap between the Class A rent versus Class B, C rent. But if you look at the lines representing different regions across the country, that premium has been stabilizing. And many of the trading up no longer make sense, right? If you look at some of the positive gap increases, meaning the Class A is now growing much faster than the Class B, C rent. For example, San Francisco, New Haven, right? The trading up doesn't really make sense for the renter household. But on the contrary, Long Island, New Orleans, Fairfield County, Charleston, San Diego, Los Angeles. So across those places, the gap continued to shrink on the year-over-year basis. So a lot of that is really from the composition of the renter household and how much more higher premium has been charged over the years. So now it's coming down to that normalization, or I mean, you're using a fancy word, mean reversion. So these places trading up is still possible. Okay. And lastly, coming down to the forecast for multifamily market, it's very busy again, but this chart shows that not a linear relationship between the population growth and household formation. This is where we are. We're still in this ramp up in terms of the household formation, which is really promising news to help us absorb that excessive supply we are seeing in the marketplace. The middle chart is the supply. So census track the housing permits and start for any professionally managed property with 5 units or above, all above. So we are seeing we are off the peak already and we're on a pretty significant downturn, which means we are probably already at the last leg of the construction boom, counting for roughly about 18 months of construction period, typically speaking. That means the housing shortage will continue to stay with us. And we are likely seeing the vacancy coming down in 25 and 26, and the effective rent will continue to grow in the positive territory. Although that'll trail below its long run average, which are represented by the dots here. But still, it's very positive to see how sustainable multifamily operators and investors will be able to maintain that cash flow. And hopefully that will serve as encouragement and incentive to start with the next cycle of this construction boom. Hopefully I end up the discussion on apartment market with a positive note. And let's move on to retail. We are really seeing the momentum being built. Okay, I know there has been many different ways of projecting, but this is my favorite chart. So I put 21, 22, all the way to 25, and put the vacancy and rent growth together on the same chart. So it's very telling. We are continuing seeing the vacancy decline, whether marginally or at a bigger gap, but we are seeing a downward trend on the market vacancy. And also, together with the decline in vacancy, we are also expecting the rent to continue to grow. There has been a lot of themes going on with retail because we all know retail has gone through a lot of trouble, a lot of the lifestyle changes and getting challenged by e-commerce. So in the decade prior to the pandemic, retail has really been going through its self-correction. I'm trying to pick the right word. Um, During the pandemic, a lot of the failed retail has been replaced by experiential retail, by mixed use community, by lifestyle, omni-channel, right? We've seen a lot of emerging trend, and depending on where you live, there might be already some kind of a mixed use retail center setting up close to you. So we've seen a lot of those positive trend, and we are also seeing the importance of an anchor tenant, whether big or small. The reason I'm saying whether big or small is because we are seeing some of the bigger department store, bigger retailer has been losing their competition to more affordable retailers. Taking Macy's as an example, right? So we have been seeing it all. Some of the small but beautiful retailers has been really taking up the opportunity. And that is also welcoming news if we are talking about neighborhood and community center type of retail. We are actually excluding the discussion of malls and super malls in the space because that is usually tracked by rates, which is a different set of data we are monitoring. But by and large, depending on which neighborhood we are talking. So for instance, I live in the Bay Area. When I look at the data for San Francisco versus San Jose, there is a very stark difference in terms of which type of retail is more successful, right? Over at the South Bay, community center is actually thriving because the way how people has been enjoying multiple different tenants, enjoying having restaurants, having the coffee shop, having some of the groceries all packed in the same community center type of format, and they can park, they can drive there, very easy, convenient to where they live, where the kids are going to school. So that form is actually thriving. But that's a luxury in San Francisco. So over at San Francisco, neighborhood center was actually thriving. So it's very hard to paint a uniformed picture in terms of who's the winner, who's the loser in the space, because it's really the retailers are finding its footing in the right form in the right place. But overall, by and large, I think we are getting a lot of tailwind for the retail sector overall. And also because retail has also been adjusting to the remote working, hybrid working regime. So some of the downtown retailers may not be gaining enough foot traffic as they usually do when people are coming to the office 9 to 5, Monday to Friday, but now they are gaining a lot of attraction uh, in the suburbs. So these are some of the trends we are seeing. But again, we are likely continue to see the ongoing evolution in the retail space together with office we haven't been talking about. This is taking the state of California as an example. Not sure how many of us are in California, but many of the places are seeing the demand, which is the lighter blue, surpassing the supply over the next 3 years. Although San Jose is probably the outlier in the space because we are expecting a lot of new supplies coming online in 25 and 26. But by and large, we should continue seeing the vacancy decline and asking rent going positive, unless we are having excessive supply issue. Lastly, I want to spend a few minutes on industrial performance because we probably have been experiencing the supply chain bottleneck has been creating that exceptional opportunity for the industrial space, especially in the year 21 and 22. So that push has coming to its end. And also we are seeing the slowdown in the new construction for the industrial space. Depending on where we're talking, I think Southern California, Inland Empire has been going through some of the recent correction because of the oversupply has become an issue. But again, if we look at the reshoring, nearshoring, and the continued need of the industrial space, and also some of the newer spaces, I mean, recreating the demand, what type of the industrial space will be more needed in the future? I'm not seeing a recession in industrial space, but rather we are seeing a lot of steadiness, normalization rather than a downturn. But I have to say that pandemic fueled gold rush is probably at its last leg. So going forward, we'll continue seeing some positive momentum on both supply and demand, but it's coming to a more normalized phase for industrial. Flex and R&D is a relatively smaller space when we talk about industrial, only because I mean it's a relatively smaller asset class. But we have also to need to monitor the softened demand. Trying to pick the right word. The startups and the lab space has been getting a lot of pressure coming from the borrowing cost, the capital expenditure, and VC funding. So that has coming. So the usual tenants for a lot of the R&D space is really readjusting their real estate strategy. And we also have to cope with the continuous supply into the space. So some of the new deliverables is not able to sign a pre-lease when it's coming to completion. So that is some of the ongoing challenges. But again, we all know R&D needs that space, and it's only this temporary period of time when the capital funding is really hitting a bottleneck. But longer term, we continue to see the R&D and flex space thriving in places like San Diego, Boston, San Francisco Bay Area, and so on. So with that, I think I hit the 45 minutes mark. I do have some slides for the office in case anybody's interested, but I know this group is probably, yeah?
Please share the office. So kind of the contrast, everything else. We still have time, so please share the office.
Okay,
Yes.
happy to do so. Office performance, oh, I have a better chart. James know I have my secret sauce, but we have been breaking record for a couple of quarters now. So at the national level, we have been observing the peak office vacancy, which we have never been tracking since 1979. That's when we started tracking the space market data. So at the national level, we are sitting 20.3 percentage point, and that is a 20.1%. I have to correct myself because I was talking about the different set of metros we are tracking when we group all 200, nearly 300 metros altogether. But the top tier is over that 20 percentage mark. So what this indicates, the market hasn't been settled down or settled in a equilibrium yet. So a lot of the trends are emerging. Number one, we are seeing hopefully the next chart is actually showing that. So the office attendance rate has been normalizing, meaning a lot of the metros settle in 50, 60 percentage point in terms of office attendance, but we are nowhere close to 100% using the pre-pandemic level as a benchmark. And the other trend we are seeing is some of the lease renewals or new tenants occupancy prefer, number one, with all the collaborative working amenities. Number two, smaller sizes. So we are seeing a lot of sizing downs in the office space, meaning if an office space has become available, whether that's through direct leases or subleases, we're likely seeing more than one tenants taking up that space. So we may be looking at the same amount of office tenants, but now they are only occupying 60% of the total office inventory, available space. So that is a problem. So with that in mind, we are looking at another few years. So right now at the national level, we are looking at least towards the end of 2026 to see the turnaround. For other places, it may even take longer. So the reason I say for other places is really taking some of the traditional, headquarters, some of the more desirable office markets like Dallas, San Jose, New York, Oakland, Seattle, Los Angeles, and so on. So these may take longer time to recover. And it's actually very telling why some of the markets are getting much more stress than other places is really because of the concentration of industry, right? So for people who have clients in the Bay Area, you probably have a good understanding or grasp of our typical office tenants composition. And with higher concentration in the technology space, we call it a FIRE. FIRE stands for finance, insurance, and real estate. So, which is very questionable. But there has been a period of time those companies are not requiring employees to come back to work. And of course, some of the irrational expansion we've seen at the beginning of the pandemic or even prior to the pandemic is coming to an end. So some of the office tenants are slimming down or even consolidating office space altogether, right? So Google may not need so many different office locations in San Francisco, although they decided to keep a few, but they are exiting one marketplace, one market street. So they are shedding off some of their real estate portfolio, although keeping some. So we are seeing all. And also there is a very interesting trend in terms of Class A, Class B, C, urban and suburban. So in that space, it's a very notable lagger for BC properties in the urban setting, in the CBD, because really it just can't compete amenity-wise, price-wise, and so on. So we have all these spaces sitting in the market, being vacant. That's why there has been a lot of talks over converting an underutilized office space into residential, into mixed use, or even into um, hotels. I know it's a less discussed point, but it has been brought up at various occasions. But there has been a lot of discussion and also uh, local officials has been providing the tax abatement, some of the incentives, or even financial support in incentivizing some of the conversion. Needless to say, it's more of a phenomena in places like Texas, New York City, but less so in other places. I know there has been one conversion which has been successful in close to Oakland, converting an underused industrial warehouse into a residential space, but less so in San Francisco City or San Jose. So it really depends on the locality. Some of them are economically feasible and they got a lot of support. Like in New York City, there has been one designated person who's helping you with the permit and stamps across multiple different offices. It may not be the case for the city of San Francisco, right? And depending on the housing shortage, depending on the feasibility, and also the experience of the developers. Because taking the city of New York as an example, there has been a long history associated with the office conversion since 9/11, right? There has been revitalization of the downtown using some of the conversion opportunities for the decades in making. So they gain all these experience of how they can provide the lighting, how they can carve out either the inside or chop some of the existing office spaces, how they convert the plumbing, the lighting, the kitchen, and so on. So it's actually a very complicated process altogether. But for inexperienced developers in other places, this may be a much bigger hurdle to cross. But needless to say, there has to be a way to solve the vacancy problem for BC properties, especially those constructed prior to 1995 or even in the 80s or 70s in the urban setting. So those places will likely facing much more challenges than others. But on the contrary, if I'm very close to San Mateo, which is, if you are not familiar, close to the Stanford University. If I compare and contrast with the offices in the San Mateo area versus offices in San Francisco, office in San Mateo was actually in high demand, whether Class A or Class BC, right? Because it's closer to the population center. And it turned out all those places which are closer or shorter in commute are in high demand. So this comes to where people like to live and how they are planning for their future working in the office setup. So we are seeing there's an interesting shift. And more interestingly, together with where people live and where they work in the post-pandemic world, retail and industrial will follow suit. So I think, James, that's a very good ending for this conversation. It's really talking a lot on the current economic cycle and what we are looking for into the future. And hopefully I brought some hope to this group of people. But if you have any question, any doubts, please feel free to let me know.
Lou, thank you so much. I think that is informative. I think everyone loves that the bottom is forming. Unfortunately, if you're still in office or office product, you still got a little ways to go because it's not certain yet, but the other product types are kind of forming that, like you said, the ruler with during the pandemic. We got the bubble with the extra capital, but now office still has a little way. What could you tell people for, from what you see with the data and the little guidance for 2025, what do you think, possibly with the rate cuts and drop, what do you kind of see that you can kind of end with some guidance or some, looking in your crystal ball for everyone here?
See, whenever I try to pull out my crystal ball, I usually get it wrong. So I would rather listen to you guys. But we started seeing a lot of investors seeking opportunity even a quarter or two ago because they were really worried they are going to miss the boat. I think that's the irrational part of the market transaction. They are really banning on. I think there was a chart which I kind of going through really quickly because I don't want you to hang your head on that chart, which is this one, right? The bubbles and the ruler thing, because people were looking at and they were pairing that with, oh my God, multifamily bottom was already forming in 2023. I missed the boat, which in reality is not the case, right? And on the other asset classes, this one is retail. Retail bottom is forming. Should I invest or should I wait? So there has been a lot of every single discussion that I participated. There has always been people who's rushing and people who has been hesitant. But really, I think just like you are shopping for your house, it's really about that one. Is that one the one you look positively, right? So the interest rate cut will start giving the clarities in terms of the lending interest rate, whether we are seeing more price discovery, because right now we are seeing a pretty widened bid-ask price But now with the normalization or corrected expectation on the interest rate trajectory, a lot of that discovery will come to a agreement. So we might start seeing more transaction will coming and entering the marketplace, and we might have to lose the boat if that happens. But anyhow, that's see, whenever I try to put the crystal ball, I always got it wrong. But yeah, don't miss the opportunity if that's the one. That's my advice.
Lou, thank you so much, and thank you, Moody's, for doing this presentation and supporting. So we look forward to catching up again, maybe first quarter of next year for another update of what's going on. But thank you again, Lou, for your great, fantastic presentation. And let's see, if you got the crystal ball right or wrong. But either way, thank you so much on this. And please join us every Wednesday for Top Agent Nation Commercial Wednesdays. And we look forward to seeing everyone again. Everyone have a great day. Thank you so much.
Thank you. Bye.
Bye-bye.